Hi folks, another Tuesday evening. Welcome, welcome. Good to see all the pre-show chat booming tonight. A lot of good points being made about debt and number of properties for sale, auction clearance rates, a whole lot of stuff. So I'm going to put the pre-show on just for a moment. Hope we're all well this evening. I know the Melbourne weather's pretty awful at the moment. A lot of wind, maybe some rain as well. And of course, we're still dealing with the East Coast low problem from last week with all of the clear up. So been a bit sticky there, I'm afraid. But anyway, we'll hopefully be able to move beyond the weather and talk about some of the financial weather. Because, of course, the RBA made their announcement today, which got a few people offside, Domain included, which was quite funny. The dogs are here as normal, I think. Yes, there we go. Looking pretty relaxed. They've had their lunch. They've had their walk. So hopefully they'll be quiet. Although, as I often say, the problem is, of course, we get our bins emptied. So sometimes the bin man upsets the dogs. So it'll be, well, noisy. As normal, it's the show set up here. It's just me tonight. So it'll be nobody on the guest screen, but everything else is running. So we've got super chat and the various controls there. We've got the multi-view over there. The other screens with my information as well. So everything is running. And I think we're all set to go, hopefully. It's interesting. Some days you turn the machine on and everything works, and other days you turn it on and nothing works. So today was a good day. So let's hope it stays that way. Anyway, we've hit the 8 o'clock mark. So I'm going to take the pre-show off. I'm going to run the starter show. I'll be back in just a moment. Well, good evening. Welcome to this live stream on the 8th of July, 2025. It's Martin North here from Digital Finance Analytics. Great to have you on this evening, and nice to see a number of the old faithfuls coming back again. Thank you very much. And some new names as well. So welcome to you too. Nice to see you on the show tonight, and I hope you're going to get a lot out of it. There's a lot to talk about, of course, what with the RBA and everything else. So we'll get into that. It's just me tonight. There's no guest, but that means that I can share with you some of my analysis and thoughts, and also do a deep dive on some of the specific postcode stuff that I think is really important now. As Cookie and I were saying in the chat just now, you can go postcode to postcode and you can see very different things in different areas. So it's quite interesting to go that granular. Just before I go on, let me just remind you that we're not providing specific financial or legal advice. This is a general conversation only. We moderate the chat, but feel free to throw your questions and comments in there. I would say that because I'm running this show without a guest, I may miss some of the comments initially, but I'll try and catch up as we go through. I have enabled Super Chat, so if you'd like to get your question to the top of the list, you can do that using Super Chat, or indeed make a contribution to what we do around here. Greatly appreciated. Does help us to cover some of the costs. We don't do this for profit. We do this because we think there's a really important conversation to have. And if you use that Walk the World, that'll get your question or comment into my queue, which gives me a greater chance of seeing it. Well, here we are, of course, and I guess the first point to highlight is I called this rate cuts, home prices and financial stress a granular deep dive, and that's pretty much what we're going to do. But I guess we should start with the elephant in the room, the RBA. The RBA, of course, did what some people, but a few people only, thought they were going to do, which is quite interesting insofar that they left the rates where they were. Surprise, surprise, perhaps. Cash rate remains unchanged at 3.85%. Headline inflation was, of course, influenced by the temporary cost of relief. And I just want to highlight, I've been saying for some time that the inflation data is actually being fudged by all this government intervention. But in a way, Chalmers has been found out now because the RBA is still looking through it. They did say that, 50 basis points from where they were, and the broader evolution is happening as they expected, so nothing to see here. So that was their take on things, which I thought was quite interesting. If you look at it in slightly more detail, they highlighted the fact that the world economy, uncertainty still remains there. We've got private domestic demand, in other words, the private sector, households, spending a bit more. Real household incomes have picked up. Now, I got a question about that. Some household incomes have picked up, but others haven't. Households at the lower end of the range because of the recent award increases, have had a bit of an increase, but not necessarily others. Labour is still constrained, according to employers. Looking through quarterly volatility, wages growth has softened from its peak, which is actually probably what is relevant. Domestic and international developments are still uncertainty there. And there's also the question about the lag in monetary policy and how that plays through with firms' pricing decisions. And I think there are lags. We are definitely seeing lags in the various elements that are going on there. And, they basically said, well, ahead, the board continues to judge the risk to inflation become balanced. The labour market remains strong. Heightened level of uncertainty. The board judged it could wait for more information to confirm that we're on track to reach the 2.5% on a sustainable basis, and they're going to pay close attention to the global economy and financial markets. Now, interestingly, this was the first time that they actually declared the votes. It was a majority, 6 in favour, 3 against. I favour the greater transparency, but of course they don't tell you who voted which way. So that's quite interesting. Now, of course, the response from the markets were all over the place, but the here we are. Jim Chalmers, surprised by the decision. Unnecessary suffering as economy is on life support, said one economist. On the other hand, if you're a saver, rate hold relief for some. And as for what next, well, the financial stress and mortgage stress is still there. And all of that stuff is clearly a part of the problem. And I guess the point I want to make is that bearing in mind where we were, it's worth just understanding a couple of really important things. The first is that if you look at the labour market, Australia labour market is still very tight relative to global peers. And that's something that I think is really worth reflecting on. So unemployment is relatively low. People are still getting jobs and working multiple jobs, which is something which I think a lot of people have not really taken into account, taking on board that if you have a job, you're more likely to be able to muddle through than if you don't have a job. But the Financial Review basically said, the central bank doesn't have monetary policy on autopilot, and we're going to have to get used to the cash rate at 3.85% for a bit, or maybe 1 or 2 notches down, and just forget how much easier it used to be. And this is the thing I get very frustrated about with the RBA, going slow, but all the spruiking, talking about rate cuts. Interestingly, Reuters reported that the futures are now implying an 88% chance of a 3.6% cut in August, and bottoming rates at 3.1, not 2.85%. And that's a really quite significant move. David Taylor at the ABC said, it's entirely possible if the June quarter core inflation comes in at 2.7 or above, we may need to wait quite a while for the next interest rate cut. So interest rate cuts are not baked in. We are in an easing cycle, that's true. The question is at what pace? And the other point that the article from the Fin Review makes the point that the slower the pace of interest rate cuts, the fewer we're probably going to get before the rate cut bottoms out. And they highlighted 2 things, just how wrong the market got it, and that the vote was disclosed, which was the first time. And talking about the markets getting it wrong, well, this was, of course, the earlier article that said most expect the RBA to cut rates. A survey of Australian Financial Review economists said 32 out of 36 expected the central bank to reduce the cash rate to 3.6%. Economists at Citi, Beta Shares, Morgan Financial and Macroeconomic Advisory told the survey that perhaps they would hold. And Citi basically said, we need more data. So that was quite interesting. But on Monday, the money markets had a price in the 95% chance of an RBA cut on Tuesday and an 84% chance of 2 rate cuts by August. So there you go. You can basically say, well, things have changed and now we're not quite sure. Now, what I want to highlight is the massive spruiking that was being done before these rate cut announcements came through. And I did make an earlier show called How Will the Current Property Mess Play Out? And look, here's a very important point of departure. Household income is still, from a disposable income perspective, down from where it was. It might have upticked very slightly, but on an index basis, it's significantly lower than it was through COVID. And the other I want to highlight is the call to the National Debt Helpline. Now, that's really important. I was hoping to have on tonight a guest as well, who is actually in the National Debt Helpline group. Unfortunately, I couldn't make it happen, but I have had a chance to speak to a couple of people on the debt helpline, and they are highlighting two things. Firstly, the number of calls is way up from where it was previously. And secondly, the complex, multifaceted issues that people are facing. So it isn't just mortgage or rent, it's the other cost of living as well. And that makes it very, very difficult for people to figure out how to deal with this very complex situation. It's a long-standing complication for many. Now, true, some people are saying, well, I can actually continue to make the repayments at the higher rates despite the fact the rates have come down. That's sensible if you can do it. But the bottom line is, of course, that we've had a lot of spruiking up till now. Here's one: the horse is about to bolt, auction boom as rates fall again. Well, Or this one: buyers poised to pounce on rate cut. The RBA tipped to deliver more mortgage relief. And then, of course, you've got all of these headlines about go west. That's where all the deals are. Or this is where you should be buying in the July suburbs. It's a cool time to sell. There's a lot of people. Winter's hot for the bargains. I mean, you can't make this stuff up. But let me just highlight this. Sydney's home prices are 41% above fair value, says AMP Research. And, it's definitely way off where it should be. And that's why I keep coming back to the fact that if I look at the combination of income versus prices, we know that incomes have just not grown enough. And therefore, we've got a big issue. Now, clearly, we can still see the elastic going to expand some more, because the other point to make here is that one of the barriers is prices are still rising in some areas. And people are actually being able to get slightly bigger mortgages now because of that 50 basis point cut. So there is putting more pressure into the system, and we'll talk about that in more detail. The other side, of course, is that banks were cutting deposit rates ahead of the expectation of rate cuts. So in fact, depositors are finding that their income levels are being squeezed as well. And of course, we've got 2/3, 1/3, looking at the mix of deposits versus mortgage holders. So it is quite interesting just looking at the impact on that side, which of course the media hardly ever focuses on. They're always spruiking the story with regard to the interest rate cuts coming. And, there's a lot we could talk about here, but one of the things I just want to highlight is the fact that the mortgage story and the auction clearance rate story is all over the place. And I made a show the other day highlighting the fact that the truth is that the clearance rates are nowhere near what all the BS is talking about. And that's because, of course, they calculate the percentage of sold based on the reported rather than the listed. And that's a really important distinction. So if you look at the auction results from Domain, they actually take the number sold, for example, in Sydney 413, compared with the number reported, and then calculate the clearance rate at 72%. But the number listed was 849. Now, 849 compared to 413 is a very different number. And so, Domain and Core Logic or Catality use this methodology, but it's deceptive, and many people don't understand just how deceptive it is. Now, if you go to SQM, this is the latest from SQM, you can see here that the clearance rates that they calculate at 52% for Sydney, 55% for Melbourne, 33% for Brisbane, very small number, 6% for Perth, 40% for Adelaide, 56% for Canberra, 71% for Darwin, and 50% for Hobart. But look at the very small numbers in some of these areas. So there is a fundamental flaw in the way that this is being reported at the moment. And kudos to SQM, who actually do a really good job of summarizing the true position. And the other point, as I made with Edwin on the show yesterday in our live rant, was that the number actually going to auction is down quite considerably compared with last year. And that's something else that people haven't really got their head around. So, as as Otto has said, there's some complete propaganda. And of course, Domain actually posted the rate cut before it actually was announced, and then had to pedal back, which was quite interesting. So that's very, very good. So yeah, I agree. And yet, in my surveys, the worry that I've got is that people are still believing this rubbish. So I don't know what else we can do other than just keep preaching the gospel to say there is another story here that people need to understand. Granularity is critical, which is why we're going to look at postcodes. Auction clearance rates are quite a lot lower. There are areas where prices are going up, but there are also considerably larger areas where prices are not going up. And Cookie has sent me some very good data on the, cuts in asking prices that people have actually got to countenance at the moment. And we're going to do some anti-spruik shows, not tonight, but later. Tasmania is a particular hotspot where there's a real problem. Anyway, what I want to do is to move the conversation forward with just one reminder again. This is the killer chart, right? The median helm price relative to the capacity to pay. It's still considerably down. And that is a really important point, I think, that we should be thinking about. As Cookie says, it's like a cult. Once brainwashed, the game is over. Absolutely. And it is a religion, I'm afraid. And this is why this is such an important conversation to have. And look, I'm not an anti-property person, but I want people to make sensible decisions based on good data rather than the rubbishy data that's out there. The other point I'd make is that if you look carefully at the information available on the portals, it's actually got worse and worse. So the information is that there is very little good sales information available on the portals these days. You have to go to New South Wales, you can go to the Valuer General and get the true data 48 days after or whenever it's closed. The transactions are closed. But a lot of this information is very, very spooky. And I'm afraid that once again, what we're finding is that people are just being misled. And then people grizzle to say, well, prices are going up, I need to buy now. Well, yeah, just be careful, because unfortunately, in my one-to-one conversations, I do quite often find that people are actually in some difficulty because they've made bad decisions. And by the way, you can see the data on retail sales, which is still relatively down from where it was on a per capita basis. But again, it was quite significantly spruiked. And of course, we've got the higher energy costs. This is actually over a 10-year period in most states. You can see how the energy costs have gone up. So however you look at this, the true story is that we are in a complex and difficult situation. And the last thing that we need and want is effectively the high-level stupidity, the high-level spruiking. And as I talked about the other week, fibs, bribes, and plain stupidity hooks more first-time buyers. First-time buyers are particularly, I think, at risk at the moment. And I've seen a number of people make really bad decisions based on what they have been led to believe is true. And in some cases, of course, they're borrowing money from bank and mum and dad. And of course, the government is still spruiking the, buy with a 5% deposit, or if you're in Queensland, you can get a 2% deposit. Whoa, whoopee. But there is a lot of stuff that is not being spoken about, which should be spoken about this, because the truth is that there are some doing fine when they go and buy, but there are a lot of first-time buyers who are finding that they're sliding into the mire quite quickly. And the truth is, of course, that we need migration under control, but nobody wants to talk about migration. In fact, if you talk about migration, then you're regarded as a racist or something worse. But the bottom line is we need methodical, careful decisions being taken on an informed basis. And that's where my data comes in. So that's now what I want to move on to talk a little bit about, which is the latest from my surveys. Now, for those who've not seen it before, we survey households on a rolling basis. We have 52,000 in there at any one time. We can slice and dice the data lots of different ways. And that gives us a chance to look at the segments, the geography, and the type of households. And we can also form a view of what may happen ahead using scenarios, and we'll talk about the scenarios shortly. So we take the mortgage stress data, the price trajectory and history data, the buying and selling intentions, the migration data, the economic CPI, wages, employment data, and we then put it through the core market model and the scenarios, and that gives us a view of what may happen ahead as well with our scenarios. And I do this at a very granular level, down to a postcode level. We can roll it up to state and region and all Australia level, but I have well over 2,000 postcodes in the database at any one time. And the reason that's important is because we can't just take the aggregate data at a state level or all Australia level and expect to make good decisions. But unfortunately, that's what a lot of the normal stuff is being doing at the moment. And it's interesting that Cook has just reported. I asked him to look at Point Cook, and he's come up and said, Point Cook prices drops have been sent in the mail. When you're ready, thank you. I'll try and make a show on that. And Point Cook is one of those hotspot areas that I'm really looking for because I think it's a big deal. Now, just before I continue, I will just make the point that if you want a one-to-one conversation about a particular suburb, I do offer that service. This is a confidential discussion. I can't give financial advice, but I can talk about the data and those sorts of things. And I can look at the stress data, the home price trends data, and look at where things may be going. It takes about an hour for a Zoom or a phone discussion. There is a cost involved because I have to do 4 to 6 hours work to put this all together. So it's a very good price, I think. And that includes talking to local real estate agents and the local council for the planning data. And if you are interested, you can book up via the blog. There's a link below. We're booking 3 to 5 weeks out. And because spaces are limited, it just takes a little bit of time to work through. Anyway, just a quick advert on that. I'm pretty busy on the one-to-ones at the moment because people are quite confused, and hopefully I can share some data. Anyway, let's now move on and talk a little bit about the research that I do and specifically my definition of stress. And I guess the point I want to make about stress is there's lots of different ways of talking about stress. And the way that I do it is I talk about it in terms of cash flow, money in, money out. Now, other people will look at 30% of income, although that's not that useful these days. Or they might look at underwriting metrics. Roy Morgan goes that route more than the cash flow measure. But I simply look at money in, money out. And that basically means that if you've got more outgoings, I exclude one-off discretionary items like holidays, for example. But, steady state money in, money out, then they have a problem. It means they've got to cut back. They've got to prioritize and to choose what to spend and what not to spend money on. So they can be stressed. If they've got a mortgage, we put them in the mortgage stress category. If they're renting, they're in the rental stress category. And also, investors can be in the same boat. So I look at cash flow pressures with stressed investors, and also particularly try and spot whether they're looking to sell their investment property, which is a very important leading indicator of potential stress ahead. And we can also aggregate it to look at the total financial stress across all those cohorts. And that gives us then a view at a postcode level, and we can look at it as a percentage of households, or indeed a count of households. The latter is probably best, simply because we look for the law of big numbers, and we'll see that coming through a bit later. So that's what I do. Now, if we then look at the latest data, you can see here the story with regard to what's going on. And by the way, just as I do that, let me highlight this. The RBA's model of mild to severe stress talks about budget pressures initially. Well, that's where we are for a lot of people, morphing into missing payments and then to insolvency. But that journey can be 3 to 5 years. And so I'm measuring the stress at the budget pressure level, the mild level, rather than later. Now, the stress to June is based on our modeling. Looking for rental stress first, it's come back a little. It's now 75%. It got up to 77, 78%. Now, that easing has been explained by a couple of things. One is incomes are up a little, particularly thanks to those awards. And also the growth in rental payments have, mitigated for some a little bit. But it is interesting that it's not necessarily that broad. So 75% of households. If we look at the mortgage stress, we're at 50%. So it dropped just below last month. It's come back up again. And that's quite significant given what we're talking about. So half of people with mortgages have cash flow pressures. Doesn't mean they're going to default. It just means that they're trying to make decisions based on a limited amount of income relative to the commitments that they've got. And by the way, the latest from the RBA, they keep messing around with the debt-to-income ratio because they rely on change figures from the ABS. The debt-to-income ratio is 181, but that's meaningless because that includes all households and small businesses in their calculations. If you strip it back to just mortgage holders, it's closer to 6 times income on average. So that's the sort of the starting point. And if we then look at the latest data, this is the June data for the results from the analysis. And you can see here in blue where mortgage stress improved from last month. So it improved in the ACT, it improved in the Northern Territory, Queensland, South Australia, and Victoria, but it went backwards. In other words, stress was higher in New South Wales, Tasmania, Western Australia, and overall it went up slightly. And that translates to 1.8 million households in cash flow pressure stress for mortgages. On the rental stress side, and I'm very surprised, by the way, that other people aren't homing in more on rental stress, because this is for me, the critical leading indicator. 80% of the ACT, though it went down, 80% of those in the ACT are having issues. 81% in New South Wales went up. Smaller number in Northern Territory, but the Northern Territory is a very small count of households, so it's not very accurate. Queensland, 73%, South Australia, 66%, Tasmania, 71%, and the yellow again, so up. Victoria down slightly to 74%. Western Australia up 67%. WA property is just nuts. And that gives us 75.1% or 2.3 million households overall in rental stress. Looking at investor stress, you can see there that it was up. ACT, New South Wales, Northern Territory, Queensland, South Australia, Western Australia as well, but it was down in Tasmania and Victoria, but it was up overall at 70.5, and that's more than 500,000 stressed investors, some of whom are looking to sell. And then financial stress was the aggregate. This is of all households in the postcode. So 48% in the ACT went down last month, 51% in New South Wales went up, 28% in the Northern Territory, 45% in Queensland, it went up from last month, rose in South Australia up 42%, 44% in Tasmania, 46% in Victoria down slightly, 46.9% in Western Australia up, 47.5%, which is 4.7 million out of close to 10 million households across the country. And by the way, the household count is going up because, of course, migration is still running hot. We can look at it also in terms of our segments, and you can see here that young growing families at 90%, that's a lot of first-time buyers, have the highest level of mortgage stress, but it is quite well spread across all segments. You can see there that the average rental stress was quite high as well, but multicultural establishment, the first generation migrants to Australia, 84.5% are still up there, right at the top, followed by mature stable families and stressed seniors and young affluent, so it's quite broad. Stressed investors, well, exclusive professionals who have the bulk of property investments are actually struggling. You can also see that young affluents are up there too, because of course they've got a significant portfolio of properties. Others, a smaller portfolio, but still it's quite significant. And then we've also got total financial stress, and you can see there that young growing families are in the heat of the problem, but it is quite broad spread, and urban fringe, older people, younger people. So the point I want to make here is that my analysis shows that there are cohorts across pretty much every age and demographic where financial stress is still a problem. And I have to say that this is the side of the story that doesn't get shared very often. Everybody says, oh, wages are going up, so everyone's fine. House prices are going up, everybody's fine. No, there are some people doing fine. Absolutely they are. But according to this data, there are also some people who are not. Now, what we can also do is just go into that in a bit more detail. And so looking towards some more granular analysis, these are the top postcodes for mortgage stress. And you can see there that Liverpool 2170 is at the top, followed by Campbelltown 2560, then Wanneroo in Western Australia 6065, Toowoomba, so regional area Toowoomba 4350. And you can see there that we've got a lot of people in mortgage stress in those postcodes. Some pretty much everybody's got financial pressure, others a little bit easier, but still big numbers. 48,000 in Toowoomba. Tarnit, 3029 in Victoria, Roxburgh Park in Victoria, 3064, Fountain Gate, Narre Warren in Victoria, and Pakenham in Victoria, and Berwick in Victoria. All of these are high growth corridors, of course, a lot of relatively new purchases there. We've got New South Wales postcode 2570 Camden, Ballarat 3350, another regional centre. And then we've got Riverstone, New South Wales 2765, and Queensland postcode 4306 as well. So all of those are feeling it. And just another way of looking at the same data, you can also look at the risk of default. Now, this is my modelling looking ahead. It's not a dramatic number, but you can see here that we've got, this is a count, more than 1,000 in Cranbourne. Mandurah in Western Australia is still showing it too because of the recent rise. Yeah, but there was earlier falls and a lot of people got leverage in at the wrong time. Roxburgh Park, Tarnit, Armidale, Success in Western Australia there as well. Pacific Pines in Queensland, Wanneroo in Western Australia, Gosford as well. And I find that some of those, coastal areas further up the coast from Sydney are really in difficulty. Toowoomba there as well. And then Point Cook, as Cookie said earlier on, there are a lot of people with pressures there. Well, we're seeing 500 potentially defaulting over the next 12 months. And then Bundaberg as well. So you can see there that there's a bit of correlation between high stress and defaults. Now, next one to look at is rental stress. And here you can see that Melbourne, postcode 3000, is right up there, 15,000, followed by Liverpool, 2170, Toowoomba, 4350, Westmead, 2145, Labrador, Southport, 4215, Campbelltown, 2560, Zetland, 2017, Coomera, 4209, Point Cook and Dermot, 3030, Mount Druitt, 2770, Bundaberg, 4670, Yatala, 4207, and 4305, Ipswich. That's where the rental stress numbers are highest. And I'll just make the point there are quite a few proportions where we're above 90% of people. So cash flow pressure for rental sector, very, very high. We look then at stressed investors, a bit of a different story. This is people who have stressed investment properties. In other words, their rental income is not being covered by, the costs have not been covered by the rental income, or they're looking to sell. So places like Beckenham, 6107 in Western Australia, Hornsbury, 2077, Lane Cove, 2066, Samson in Western Australia, 6163, Toowoomba, 4350, Maroubra, 2035, Strathfield, 2135, Craignish, 4655, DY, 2099, Mandurah, 6210, Queensland, postcode Gladstone, 4702, and Queensland postcode Southport, 4215. And finally, this is the overall story with regard to financial stress. This is the aggregate number. So in 2170, 74%, or more than 28,000 households of the 39,000 have a problem. Toowoomba's up there too, 54%. Campbelltown as well is very high. Hoppers Crossing, Dermot, Point Cook, Craigieburn, Beckenham in Western Australia, Ipswich, Melbourne, Mount Druitt, Southport, Cranbourne, Ballarat, Pakenham, Wanneroo. So the usual suspects in a way, but it is worth just noting where those hotspots are. Let's talk about scenarios now. And I just want to highlight that my scenarios are not forecasts. This is not me saying property prices are going to do X, Y, or Z. They're just showing the sensitivities. I've tried to explain this over the years. I still get hit over the head with a 4x2 people saying, you said this. No, I said these are scenarios. If people want to then pick scenarios and run with them, that's their problem, like Channel 9 did. But I run scenarios. Then ways of exploring different futures and considering the consequences, they're not forecasts. But it shows you some of the sensitive and some of the movements. None of these could be right, and they do change from time to time. Now, if I look at my scenarios, I've got three. The best is the Goldilocks zone, where we get a further rate cut in July to 3.6%, and we get another one later in the year. Inflation eases in line with the RBA expectation. Wages rise faster than inflation. We don't get a recession. Migration remains above average. So that is the sort of the sweet spot, the Goldilocks zone, I suppose. The more realistic soft landing is that we probably see the rates staying a little higher for a bit longer, maybe until September, and we get some fall of inflation, but it rises again and it stays above target until next year. We don't get a recession in Australia, but migration falls. The third one is the worst, the nightmare, where we see rates staying higher for longer, we see inflation stepping up, employment starts to rise, and wages growth stalls due to the second order effects from the trade issues, thanks Trump, and we then get rate cuts later. Migration drops below average though. Those are the three that I use. Now I could use others, but my point is that this just gives you a bit of sensitivity analysis to tease around. And if we then do that, this is the scenario for the Australian story over the next 3 years. This is a cumulative story. So the best case suggests there's still a 9% rise in house prices, assuming that it plays out. If you get the base case, then there's more likely a bit of a fall, and the worst case, a more significant fall, and units will follow on quite considerably, although perhaps not fall quite as much. Now, I did have a number of people say, can you do the states? So I'm just going to go through each of the states and give you the latest. WA, the best case is a rise of 17.3% over 3 years, so still further rise. The base case is a pretty much going sideways, actually 2.4% over 3 years, and the worst case is a fall of 17% over 3 years. If we look at units, they tend to follow on quite closely. If we then look at the Queensland story, again, significant rises, maybe up to 14% over 3 years, sideways, going almost nowhere of the base case, and the worst case, a fall of about 20% over 3 years, units following along a bit. If you could then go to New South Wales, 8% rise over 3 years, best case, a fall of about 6% over 3 years, the base case, and a worst case of 26% over 3 years, and units again following along. We then go to South Australia, a 16% rise over 3 years, potentially, in the best case. Base case, a small rise, 1.2%, and the worst case, a fall of 18% over 3 years. Worst case for units, not quite as bad, but going roughly the same. And if we then look at the ACT, small rise, 2.8% over 3 years, best case, a fall of 12% base case, and a 32% fall, worst case, and units following on. And looking at Victoria, you can see there that there's a small rise, best case 3%, base case a fall of 11%, and worst case a fall of 32% if things go really pear-shaped. Victoria has its own problems, of course, with debt and a few other things going on down there at the moment, and also some very negative initiatives relating to investment properties, which, by the way, New South Wales is starting to emulate now. And looking at units, it's pretty close as well. And then look at Tasmania. The best case, a small rise over 3 years. The base case, a fall of about 13%, and the worst case, a fall of a third if things go really badly. Units following on as well. So that's the sort of the main story. So that gives you a sort of a grounding then in my granularity analysis, and it shows you that there are big movements that are differentially happening in different places. And, you compare that with what CoreLogic said, and you can make your own calls as to what you think may play out. But anyway, that's my take. The NT one is so difficult to forecast because the volume is so low. I'm not going to share that one today because I don't think it makes a lot of sense to go into detail on that at the moment. But now what we can do is we can look at the postcode level analysis. And to do that, I'll bring up this one. This is my standard template, of course, which you may well have seen. And if you have, you will understand the way it works. The truth is that this particular piece of analysis is quite detailed, and I can switch across to this version if I just make a bit of a change to here and make it live. Okay, so this is now the data for this particular postcode, which is Wollongong. And the thing to understand here is that the base census is still 2021, but I've updated the taxable income data, which came out quite recently, to the 22-23 financial year. And that gives us a little bit of a change to some of the data. But nevertheless, in this particular postcode, just as a sort of an example, you can see 19,000 households, 28% only outright. You can see here that we've got 23% borrowing and we've got 48% renting. You can also see that we have a third in mortgage stress and 75% in rental stress. Where we've got big numbers, it highlights it. Overall financial stress is at 53%. You can also see that we've got 35% of houses and 52% of units and some other types of property in this particular postcode. We've got a people ratio, that's the proportion of people per property, and you can see at 2, that's couples and maybe some families. As it goes up, we get more families, it drops, then we get more individuals. Vacancy rate based on the census, so that's probably a bit misleading now because that was done at the end of COVID, but we've got the best data on that we've got, so we have to use it. Gross investment yield, 3.4%, so that is the relationship between the home price and the rental income, assuming the property is fully let at market rates. The net investment yield is the relationship between the cash flow in, so that's the rental received, including if it's vacant, and also the costs that you shell out, and that includes for rentals. Rents could include covering the cost of the mortgage, could include covering the cost of management, could include the costs of maintenance and other things too. And when you put all that together, the gap between the income that you get from your rent and the costs going out can put it negative. And where you have a net investment yield that's negative, what it means in practice is that people are losing money on a cash flow basis and are banking on the capital appreciation, which is why the price scenarios are quite relevant, because if you actually believe that based on your scenario where you think prices might go, then you might hold on to a loss because of the expectation of capital gain. But if you don't expect capital gain, it might give you a reason to sell. So that's the way the model works. And as I say, it's updated now with the average taxable for 22-23, and it gives you a bit of a flavour of what's going on. So what I'm going to do now is I'm going to look firstly to those who asked me to cover some postcodes in the chat from the earlier show, and then I'm going to look at the chat locally here, and I'll be able to do some real-time ones. But let's just start with one or two of those where people asked for the data. And the first one here is Illa Wong, postcode 2234. So that's come up as Alfred's point as well on mine. So if I cut back to my model, so this is now postcode 2234, and you can see here that in this postcode, we have 10,000 households, 42% owning outright, 48% are borrowing, a lot of borrowing households there. Small number renting, 9.5%. You can see that the mortgage stress is at 47.9%. Rental stress is 100. A lot of people in rental stress. And look, it's plus or minus a few percent because of the sampling, but it's high. Stressed investors, 19%. So overall financial stress, 45%. You can see here that the 86% of houses, a small number of units, are types of property. High people ratio, so that's families. Low vacancy rate at 2.7%. Gross investment yield is 3.4%. The net investment yield is 1.1 negative. So people are underwater from a cash flow perspective. Looking at the taxable income on an individual basis was 105,000 according to the ATO. The household census spoke about household income 142,000. So the multi-flag comes up suggesting we've got multiple incomes going to help pay the mortgage. But it gives us a disposal monthly around $8,000 a month, with $39.5 or $3,200 going on the typical mortgage, and $36.5 or $2,990 going on the typical rent. And looking at the scenarios, best case a 3% rise over 3 years, the base case is for houses down 12%, and the worst case down 32%. So there you go, that's that one. Okay, I had another request. This was for Penrith from Ernest. And if I cut to Penrith, it includes Emu Plains as well as Penrith. 20,000 households there. 26% own outright, 32% are borrowing, 41% are renting, 61% in mortgage stress on my definition, 67% in rental stress, some stressed investors are 16, Financial stress just over 50%, so it gets highlighted. 65% of houses, 21% of units are types of property there. People ratios 2.23, so some couples, some families, as well as individuals. Vacancy rate was high at 7%. 3.2% is the gross investment yield. Minus 1.3 is net investment yield, again underwater. Average taxable, 87. Household census said $86,000. Gives a disposal monthly around $5,800, with 42% going on typical mortgage, 2,495, and a third, 1,944, going on the typical rent. And I'll highlight the fact that this is percentage of disposable monthly income. Now, when people talk about 30% of gross income, they are missing the point. In my data, I'm seeing a lot of households with 40 or even 50% of disposable monthly income going on the mortgage or the rental, which is nuts, really. Looking at the household, you can see the trend here is house prices up 7.2% over 3 years. Best case, base case a fall of 8%, and the worst case a fall of 28% for houses. If I go to my next one, this is Victorian postcode 3200. And this was Frankston North. And here you can see just 2,300 households, so a smaller postcode, 25% earning outright, 29% borrowing, 45% renting, a lot of mortgage stress, quite a lot of rental stress, quite a lot of stressed investors as well, and overall financial stress of 78%. That 78% translates into a negative influence on price scenarios, by the way, as well. 93% of houses, small number of other types of property there too. People ratios 2. The vacancy rate was quite high, maybe some second homes, I'm not sure there. But you've got a 3.6% gross investment yield and a minus 1.1% net investment yield. The average taxable was reported 67,000. The household census said 58,000. And that gives a disposal monthly around 4,300 with 39.3% or 1,690 going on the typical mortgage and 1,570 or 36.5% going on the typical rent. And you can see here that the expectation ahead is for more price falls rather than rises under every scenario. 12% in the best case scenario down to 47% in the worst case scenario. So not happy. And quite a few of the postcodes in and around Melbourne are seeing still negative trends despite what the spruikers are saying. So that's just one point to note. If I then switch to the next one, this is postcode 5073 that I was asked for. And this gives us Rostrova, 7,000 households there with 38%. 78%, sorry, 7,000 households, 38%, 34% borrowing, 27% renting, so more owning outright than anything else, 75% in mortgage stress, 50% in rental stress, some stressed investors as well, households in financial stress, 42%. We've got 75% of houses, some units and types of property there. The vacancy rate was 6.2. Gross investment yields are 4%. Some of the Adelaide suburbs are doing quite a lot better. Net investment yield is just underwater though, minus 0.1%. Average taxable is 85,000 versus the census at 86,000, giving a total monthly income from a disposable perspective at $6,300 with 35% going on the typical mortgage, 2,210, and 27.6%, 1,745 going on the typical rent. And looking at the trends, price growth positive, 12% in the best case over 3 years for houses. Base case a small fall, the worst case a more significant fall around 23%. And then I've got another one here, the last one that I was requested beforehand. And this is a postcode 6163. This is Sampson in Brand. And here you can see 23,000 households with a third owning outright, 39% of borrowing and 27% of renting. 40% are in mortgage stress, more than 3,700 households. Not much in the way of rental stress. Some stressed investors, but 25% in financial stress. 75% of houses, some other types of property there too. The people ratio is 2.13. The vacancy rate was 8%. 4.6% gross investment yield and positive net investment yield of 1.2%. So here, investors are making a return. 93,000 for the taxable income, 85,000 for the household census. Remember that the census relates to 2021, so maybe possibly incomes have risen slightly since then. Disposable monthly 5326, 40.9% going on the typical mortgage 2178, and 32.8% or 1745 going on the typical rental payment. And just make the point that this disposable monthly is derived directly from the latest data from our households surveys, not from the census data. Okay, so that gives you a bit of a flavor of what we're seeing. Now what I'm going to do is I'm going to go have a look on the chat and see what comments people have been making, and also perhaps answer a few postcode specific queries as well. So let's just have a look and see what is going on. A lot of activity in the chat. Welcome all those people who are saying hi. Nice to see you. Alison, hi. Nice to see you there as well. And what else are we seeing? Cookie Boy makes a point. The Aussie 10-year is now 4.3. It was 4.18 this morning. Yes, we are seeing that movement up in rates, and I've beginning to get to the point of questioning when the next rate cut might be. Remember, the quarterly inflation numbers coming out later July, and that will tell us something quite important. And we also get the unemployment rate as well. So those pieces of data will be important, but the way the markets are behaving at the moment, and perhaps they're reacting to the Trump letters that went out, higher tariffs than people expected. So the tariff thing has come back. I did a show over the weekend highlighting the fact that tariffs were still a thing, which upset a few people because they thought it was all very quiet. But, the fact is it's very different. Cookie also made the point, if I do price drops on apartments, I'd have to do a 3-hour video slideshow. Yeah, absolutely. This is the problem, of course, with so much data coming through and so many examples of falls. It's going to be a lot of work, and that's part of the issue with everything else I've got on at the moment. Finding time to do all of this is a problem. I'm still running my stress analysis in the UK. I'm not publishing in the UK yet because I'm working for a couple of particular clients, but hopefully later I will, and we can make some compare and contrast. All right, just looking down the... Okay, Cookie Boy asked for 3030, which we can do. Okay, let's have a look at that. This is obviously the famous Point Cook and Durham. And you can see here that we have 41,000 households in this particular postcode. And I just want to highlight the number, 41,000. It's a big postcode, very populous. 20% earning outright. Look at this, 47.4% are borrowing. Huge number. 32% are renting. You've got 39.6% in mortgage stress, but that's more than 7,800 households. That's a big number. Rental stress at 71.7%. And you can see there's a bit of investor stress as well. 45.1% households in financial stress. So that's a big deal. And you can also see that the mix of property, it's mostly houses, some units and other types of property there. The people ratio is quite high, so it includes a lot of families. The vacancy rate was a little high back in census time. Gross investment yield's positive 3.2, but net investment yield is minus 1%. And that's interesting observation, bearing in mind that the stressed investors are relatively low count at the moment. Looking at the taxable income, 89,000 average taxable, or 106,000 based on the census data, and the multi-flag comes up, suggesting multiple incomes. Disposable monthly income translates to about $7,500 a month, with 31.9% or $2,000 going on the typical mortgage, and 24.6% going on the typical rent, which is 1,849. And I will make the point that the costs for people living in these outer suburban areas are very high because of transport costs, because of lack of infrastructure, and even in some cases, particularly in the outskirts of Sydney, tolls as well. So something to bear in mind. So there you go. That's the story of the situation with regard to the Point Cook and Durham postcode. Okay, then Cookie says 4810 because obviously prices have doubled there. Yes. So this is North Ward in the Northern District of the area around Townsville. 10,000 households, 24% owning outright, 26% are borrowing, 48% are renting, 63% are in mortgage stress, 30% are in rental stress, and the overall financial stress is not massive, but it's there. 43% of houses, more units than other types of property. People ratio is low, including some individuals, I'd suspect. The vacancy rate's very high. That includes Airbnb and some second homes and things too. Gross investment yield is 4.1. We find that often with some of the Queensland postcodes that the gross investment yield is 4 plus, but the net investment yield is negative, minus 0.3%. The average taxable, 100,000 from the ATO for 22-23. The household census from 2021 said 83,000. So there's a bit of a mismatch there, as perhaps you would expect these days. Disposed monthly around $6,000, with 31% going on the mortgage, 1920, and 24.8, 1495 going on the typical rent. And you can also see here that the expectation is of further price growth, 15% in the best case scenario, very small amount in the base case, and a 20% fall in the worst case scenario for this particular postcode. So significant pressure, but not as much pressure as some other places. Okay, that's that one. Now we've got one here for postcode 4870. And this is again in the Cairns area. There are 29,000 households, 25% own outright, 33% borrow, 40% are renting, 36% are in mortgage stress, 42% are in rental stress, some stressed investors as well, and households are in financial stress at 31%. 59% of houses, some units and types of property there too. The vacancy rate is 10. Gross investment yield is 4.1. Net investment yield is minus 0.4. Average taxable 83 compared with 78 from the census, giving a disposable monthly around $5,800 a month, with 34.1% going on the typical mortgage, 1920, and 27.5%, 1544 going on the typical rent. And you can see here that prices are expected to go higher, 17% over the next 3 years. Best case scenario, the base case, a small rise, the worst case, a bit of a fall. Okay, what else have we got? Bossman says, North Queensland has gone crazy. Yes, tend to agree with you. There's quite a lot of demand. Interstate migration is very strong. If you look at the latest census data and the ABS data, a lot of people have bought up there from Melbourne and Sydney, which I think is quite interesting. As Jason has said, in some parts, price-wise and crime-wise, the other interesting observation is, as Jason says, I've been tracking some of the financial stress. I've also been looking at the crime statistics, and in some of those postcodes, crime is really climbing, which is so an indicator of more stress, and perhaps also some of the differences in terms of the type of people who are coming up there. So it's a good point, Jason, you make. Now, Gavin asked for postcode 2250, which we can do. Just put that one in. This is Gosford. And 29,000 households, 30% earning outright, 38% are borrowing, 31% are renting. Mortgage stress 29.5% of more than 3,000 households. The rental stress at 90%, more than 8,000, I should say. 24% stressed investors, and 44.7% overall financial stress. 69% of houses, some units and types of property there. People ratio is 2.31, so at the higher end, so families as well as individuals. Vacancy rate was 6.6%. Of course, that could be second home and Airbnb as part of that. 3.4% gross investment yield. Net investment yield minus 0.8%. Average taxable 88,000 compared with 84,000 from the census, giving a disposal monthly of 5525, with 43.4% or $2,100 going on the typical mortgage and 36.1%, 1993 going on the typical rent. And I would say I see this in a lot of those Central Coast areas where, in fact, we have a lot of people with big mortgages or big rents, and the costs are very high relative to their total income. And looking at scenarios, best case of rise over 3 years of 7.5%, the best case a bit of a fall, and the worst case a fall of 27% in units following on. Got another one here to look at. 3070. Thank you for asking. So 3070 is Northcote. Whoops. So I can get rid of that. Just 1 second. I have a slight technical issue. Just 1 second. Yeah, I managed to move my mouse pointer and couldn't get it to work. Sorry about that. It's easier to take it off screen now so you can see the full result when I put it up. Just a second. Let's put it up now. Right. Okay. 3070. 11,000 households. 30% owning outright. 32% are borrowing and 37% are renting. We have borrowers in mortgage stress at 32.6%. We have 81% in rental stress, some stressed investors, and 49.1% households in financial stress. 49% of houses, 22% of units are types of property. High vacancy rate, that could well be some Airbnbs and other things going on there. Gross investment yield is 3.3. Net investment yield is minus 1.6%. Average taxable 120,000. The census said 118,000. And that gives a disposal monthly of 7,950 or 36.2%, 2,880 going on typical mortgage, and 29.8 or 2,367 going on the typical rental payment in this particular postcode. And I'm afraid there isn't much good news in terms of price rises. In the best case scenario, going sideways. In the worst case, a more significant fall ahead. Okay, Bossman asks for a couple of postcodes. 4150, we'll do that one first. This is Caboolture. And here, 21,000 households with 26% owning outright, 36% borrowing, 37% renting, giving us 17.3% in mortgage stress, 94.7% in rental stress, some stressed investors, households in financial stress, 45.5%. We have 83% houses, small number of types of property there. We have a people ratio of 2.43, so families, 6.9% vacancy rate, 4.4% gross investment yield, minus 0.1% net investment yield. And the average taxable was 72,699 from the ATO and 68,000 from the household census. That gives a disposal monthly around 4,600. 41.4% going on the typical mortgage, 1,906, and 35.2, 1,619 going on the typical rent. And from a from a scenario perspective, best case up 11%, base case down 3%, and the worst case down 24%. And you also asked for 4519. This is Biwa, and 3,565 households in the particular area. 32.8 owning outright, 43.1 are borrowing, and 24.2 are renting. That gives a 37% in mortgage stress, 100% in rental stress, give or take, and 43.8% overall. We have mostly houses in that area. We have a people ratio signifying probably more families than solos. And we have a vacancy rate around 5.7%. Gross investment yield is 4.4. Net investment yield is positive 0.4. And again, I'll highlight the fact that this is in the Sunshine Coast hinterland. Net investment yields were quite a lot better than, for example, in and around Victoria or indeed New South Wales. Average taxable 80,000. Census says 79,000, so pretty close. giving a disposable month around $5,100, with 40.5% going on the typical mortgage, just over $2,000, and 37.8 or 1944 going on the typical rent. Scenarios are a rise. Best case, 9.4% over 3 years. Base case, a bit of a fall. Worst case, a more significant fall. Now, Cap T asks for 3013. $3013 is Yarraville with 6552 households, 26% owning outright, 40% are borrowing, 33% are renting, 28% in mortgage stress, 75% in rental stress, a bit of investor stress, financial stress at 39%. 71% of houses, some units are types of property there too. People ratios 2.25. Vacancy rates 8.5%. Gross investment yield is 3.1%. Negative investment yield from net perspective is minus 1.8%. I'm seeing this in a lot of Melbourne suburbs. Average taxable is 115,000. The household census said 129,000 with a multi-flag. Multiple incomes going to pay the mortgage, giving a monthly disposable of around $8,600 with 34.7% or $3,000 going on a typical mortgage and 26.6% going on the typical rent of $2,302. And from a best case scenario, there is a small chance of a rise, up 3% over 3 years, but the base case a fall, and the worst case a more significant fall. That gives you a bit of a flavour of that one. And let me just go down the, see what else we can see. This phrase here says people are struggling. Life should be about thriving. And I agree with you. This is part of the issue. And, you know, all of the spruiking about the fact that households are fine now, even the RBA said it, incomes are rising. Well, yeah, but they might be rising, but costs of living are still rising. And the net effect of the 10 years plus of negative real income growth for most people are really taking their toll. And remember, what I'm looking at here is total money in and total money out, rather than just the mortgage or rental element. And that's the way to do it. You've got to look at cash flow. And unfortunately, a lot of people have got themselves very much caught up. And look, they're trying to do the right thing. They're trying to form a household and buy a house and have a family, all of those things. But it is very hard for a lot. Now, again, let me make the point. Not everybody's in this boat. There are people who are doing very well, thank you. Their incomes are rising fast. Their investments are performing very well. They don't have a mortgage. And so, you know, they're saying, what's the problem? And of course, I think our politicians often fall into that category. So they don't really understand what it's like for ordinary people. But unfortunately, my numbers suggest that a large proportion of people are in this long doom cycle. And, you know, the latest news from the RBA today won't give them any comfort at all, unfortunately. All right. And Downover Drover says Victoria's a basket case. Yes, it is. And it's partly, of course, because of bad politics down there for a good number of years from down onwards. And they haven't really learnt anything. And, of course, they're still borrowing more. Their debt deficit's rising. And they're doing more silly things. Not good. Jump for Joy asks for 6027, which we can do. This is Heath Ridge in the district of Curtin in the area of Wanneroo. 16,900 households with 31% owning outright, 46% borrowing, another high borrowing proportion, 22.1. This is the mortgage belt again. 31.5% in mortgage stress, 84% in rental stress, 23% in investor stress, and 40% in financial stress overall, more than 6,800. 85% of houses, some units there as well. People ratios 2.39, so it's again families. 6.4% says unvacant property and maybe some Airbnb and second homes as well, possibly. 4.2% gross investment yield, negative 0.2% net investment yield. Average taxable $96,000 compared with a household census of 104,000. giving up a disposable monthly income of 6,585, with 36.4 going on typical mortgage at $2,400 and 28.8, 1894 going on the typical rent. From a scenario perspective, best case up 11% over 3 years for houses. Base case a bit of a fall, 3.1% down. Worst case a significant fall, 23.4% over 3 years. Now, you've asked for Riverston. If you can tell me what the postcode is, I can put it in. I don't have a reverse lookup readily available at the moment, so I can't give you that one, I'm afraid, without doing some other things. So put the postcode in and I'll try and help. Zane asks for 4575. Okay, 4575 is Watella in Wide Bay, Burnett. 11,500 households here. 35% earning outright, 31% of borrowing, 33% of renting. Mortgage stress at 23%. Stress from the rental perspective, 62.3%. Some stressed investors too. Overall financial stress at 38.9%, relatively high. We've got 67% houses, some other types of units, other types of property. We've got a people ratio a little on the lower side, so possibly some singles and couples as well as families. High vacancy rate, 9.7%. It could be Airbnb and second homes in there. 4.5% gross investment yield, net investment yield positive 0.3. So again, Queensland proving the point about the returns. ATO said 104,000. The census said 88,000. Disposable monthly income, $5,800, giving a 42.1% percentage or $2,144 on typical mortgage and 40.4%, $2,243 going on the typical rent. Scenarios suggest a 13% rise over 3 years best case, a small fall, 1.7% fall over 3 years the base case, and 22.1% fall the worst case for houses. Okay. Cookie said 2765, so we can do that one. Did I do Riverston? Maybe I didn't. My one flaw is I don't remember if I've done it already, so I might give you the same one twice, but I don't think I did because I would remember the 100% numbers. 14,000 households here, 16.1% outright. 60.1% are borrowing, 23.8% are renting. Everybody's got problems from mortgage stress and rental stress. Some stressed investors are 83.9% overall problem. 96% of houses. People ratio is extremely high, so a lot of families. Vacancy rate's relatively low. Gross investment yield is 3.3. The net investment yield is minus 2.4%. That's a lot of new properties leveraged, I suspect there. Average tax bill is 96,000. Census said 133,000, and the multi-flag comes up, giving a disposal monthly of $8,960 with 37.7% or 3,380 going on typical mortgage and 30%, 2,691 going on the typical rent. And you can see here that there isn't much chance of property price rises, given what we're seeing here with a small fall, minus 1.3% over 3 years for the best case, through to a 36.7% worst case scenario. Okay, Bossman says Griffiths is cooked. 4575. Yeah, I think we did that one, didn't we? So I won't do it again. Cookie asks for 2600. This is, of course, right in the middle of Canberra, Yarralumma. And 3,600 households, 40% earning outright, 29% borrowing, 29% renting. 27% have mortgage stress, 88% have rental stress, some stressed investors, 41% in financial stress overall. Half are houses, a third are units, other types of property there too. People ratios on the lower side, just over 2, so it could be some individuals as well as families or couples. 9.5% vacancy rate, quite high there. 4.8% gross investment yield. Net investment yield is just positive by 0.1%. Don't just spend it all at once. Average taxable 157,000 versus 156,000 from the census, giving a disposable monthly of more than $10,000, with 32.2% or 3,383 going on the typical mortgage and 25.6, 2,691 going on the typical rent. And I just want to highlight these big taxable income numbers and this big disposable monthly. ACT is another planet relative to what we're seeing. It's pretty bad elsewhere relative to Canberra. But of course, people in Canberra sometimes don't feel the draft, is my theory anyway. So there we go. Let me just see what else I've got. Jason makes the point that Cairns is off the chart for crime now. Yeah, it's been rising considerably. And in fact, you can see the same rise in crime rates in a lot of outer suburban suburbs in Melbourne and also around Sydney too. And there is a high correlation between mortgage stress and rising crime rates as well. So all of these things are connected. And I keep saying mortgage stress is not just a financial pressure, it's a social pressure as well. And that creates a lot of issues for a lot of people. And then, of course, what you find is that when people are actually looking to buy a property, they'll check out the crime statistics and then get a bit scared. When I do my one-to-one conversations, I cover crime issues, I cover flooding, I cover fire, as well as the price trends and the planning rules and regulations and the planning changes that are expected to come through, because it's all part of building a picture. And I also include schools where that's appropriate too, because actually particular schools in particular locations can influence where people want to be quite often as well. So all of that is playing in to the story. Okay. Can I look at 2009? Sure can. Now this is Permont. Let's put the slide back up. Okay, so here, just over 6,000 households, 18% only outright, 90% are borrowing, and 62% are renting. 11.8% in mortgage stress, but 91.3% in rental stress, 46% in stressed investor land. So looking at it from the other side of the equation, if you've got a lot of stressed rentlers, you've got a lot of stressed investors as well. And overall financial stress, 73%. It's all units. Look at that, 93.7% there. It's very low people ratio, so a lot of individuals, 1.77%. The vacancy rate could well be high because at the time, this was when perhaps students were away because of COVID. Gross investment yield is 3.8%. Net investment yield is minus 0.1%. And you can see here the average taxable 129,000 versus 125,000. So it's not just students, it's also going to be people living and working in around the centre of Sydney. Disposable monthly around 8,700. 38.53360 going on the typical mortgage, and 33.1 or 2890 going on the typical rent. And looking at the scenarios, best case scenario, a rise of 6.7% over 3 years, a base case a fall of 8.3%, and the worst case a fall of 28.7% over 3 years. So that tells the story, really. Okay, Jason said 4519. Did I do that one or did I not do one? Let's have a look. Biwa, yes, indeed. We looked at that one, didn't we? Services said, service 33. What about 2765? What about 2765? Let's have a look. Okay, so this is Riverstone. I think we did that one. I'll leave it up for a second and you can have a quick look if you've not seen it before. But I think I did go through Riverstone before because I remember the 100% mortgage stress. Okay, let's have a look. Drew says 3065. Fitzroy in Victoria. 4936 households, 18% owning outright, 21% borrowing, but 60% are renting. 36% in mortgage stress for the mortgage borrowers and 75% for the rental stress. Overall stressed investors at 21% and 58% for the financial stress, giving, well, mostly units and other types of property. It could be over retail and places like that as well. People ratio is very low, 1.64, so it could well be individuals, maybe students, maybe young people. Very high vacancy rate as well at the time, so possibly this was to do with students being away as well. People ratio was, as I said, low. Vacancy rate was high. Gross investment yield is 4%. Net investment yield is minus 0.5%. Average taxable 124,000 versus 114,000 from the census, giving the total monthly about 8,300, with 36% or $3,000 a month going on the typical mortgage and 27%, 2,247 going on the typical rent. I suggest there are a lot of young people there as well, not necessarily just students. And looking at the scenarios, best case, almost nothing, 0.6% over 3 years rise. Base case, a fall of 14% over 3 years. And the worst case, a fall of 34% over 3 years for houses and units following on. Diz C says 2030, which is Dover Heights. Yes, and this is quite an interesting example because the income levels are pretty high, as you can see here. Dover Heights, 5,200 households, 41% are outright, 35% are borrowing, and 23% are renting. There's no mortgage stress. There's quite a lot of rental stress, though, and overall financial stress at 61%. The mixture of houses at 53% versus units 34% and other types of property. People ratio is 2.49, so some families. There was some vacancy there as well. The gross investment yield is 3.7. Net investment yield is minus 0.4%. Average taxable from the ATO, 300,000. Oof. Household census is 181,000. So there's a different dilution there based on the two. But nevertheless, disposable monthly is very high. But the mortgage is also very high. And it comes out at 54.9%. Now, I suspect there's going to be skewed by some very big incomes. So take that with a slight pinch of salt. But the $5,000 a month is probably close to the mark. And the $3,500 a month on the rent is probably about right at 37.7% too. There isn't much growth at the moment. I'm seeing the top end of the market being a bit squeezed, down 2% best case, down 70% base case, and down 37% for houses, the worst case. And that's one of the points I'd make, is it isn't just the lower end of the income scale where there's problems, as I've shown through my surveys. Now, you asked here, Jason, for 3065. Fitzroy. I did Fitzroy, so hopefully we'll cover that off. Good. 3196. Okay, this is Chelsea in Melbourne. 11,800 households, 31% owning outright, 41% borrowing, 26% are renting. Mortgage stress at 67%, rental stress at 75%, bit of stressed investors, but 49.9% in financial stress overall. 47% of houses, 24% of units, types of property there. 2.16 is the people ratio. Vacancy rate was 6.9. The gross investment yield 3.1. Net investment yield, again, negative, minus 0.9. Average taxable 95,000. Census said 95,000. Disposal monthly around $6,800 with 36.5% or 2,496 going on the typical mortgage and 28.9%, 1973 going on the typical rent. And from a scenario perspective, even the best case, a small fall, 1.7% over 3 years. Base case, a fall of 16% over 3 years, and the worst case, a fall of 37.8% over 3 years, which is quite high. Okay, Victor said 5073. Don't think we've done 5073, Victor. Let's have a look. I think we might have, actually. That rings a bit of a bell. Anyway, I'll give you the display. You can have a quick look down it and check back. I think I did it earlier on. And what I need to do is I need to build an extra routine. When I put a postcode in, it then adds it to a queue, and then I can do a quick check to see whether, in fact, I've done it at all. A Cookie Boy asks for the ponds, sorry. That's a bit cruel. But as Edwin says, there's a reason why it's called the ponds. 4,800 households, 10% owning outright, 67% are borrowing. I think it's the worst yet. 22% are renting. Very high levels of mortgage stress, 98%. Stress in rentals, 100%. Stressed investors, 32%. Overall financial stress, high, very high. Lots of houses, small number of types of property there. Very, very high people ratio. So a lot of families. Vacancy rate, 3.4, pretty low actually. Gross investment yield is 3.4. Net investment yield is minus 0.9. Average taxable 113,000 versus 170,000 from the census. So the multi-flag comes up. Multiple incomes going to pay the mortgage, giving a disposal monthly around 9,200 with 38.8% or $3,600 going on the typical mortgage and 34.5 or 3,204 going on the typical rent. And from a scenario perspective, a fall of 3.7% over 3 years. Best case scenario, 18.7% base case and 38.5% worst case. That's for houses. Okay, how are we doing? Okay. Victor asked for 5073. 73. Yeah, did that one. So that should be there. Already. And Nada said 3806. Is Berwick and Harkaway, one of my favorite postcodes because of the issues that are going on there. 18,000 households, 28% earning outright, 49% are borrowing, 21% are renting, a lot of mortgage stress, a lot of rental stress, and overall financial stress at 74%. Houses, 89%, well, mostly houses there in the area. People ratio is 2.76. The vacancy rate is 4.7%. Gross investment yield is 3.4. Net investment yield is minus 1%. Again, another example of the problem in Melbourne with negative returns. Average taxable 103 compared with 110 from the census, giving a disposal monthly around 6,900. 34% of going on the mortgage, $2,400, and 28.5%, 1,993 go on the typical rent. And from a scenario perspective, best case, a fall of 8% over 3 years, the base case, a fall of 23%, and the worst case, a fall of 42% for houses over 3 years. Okay, I am running out of runway in terms of my ability to carry on, but I will just do this one from Stephanie. Can I do 4563? This is actually the Black Mountain up in Queensland. 3,900 households, 46% earning outright, 39% are borrowing, 14% are renting, 38% are in mortgage stress, 100% in rental stress, and overall financial stress at 38%. Mostly houses, 2.32 the people ratio, so probably some families there, 7.3% the vacancy rate, 4.4% gross investment yield, negative net investment yield of minus 0.3%, average taxable 88,000 from the ATO, 74,000 from the census, giving a disposal monthly of 4,914, with 42.3%, just over $2,000 going on typical mortgage, and 42.6%, slightly more actually, 2,093 going on the typical rental payment there. And from a scenario perspective, best case a rise of 9% over 3 years, base case down 5.9%, worst case down 26%. So there we go. And I noticed Victor says, thanks. You're welcome, Victor. And Lucia says, 3087. This may well be the last one tonight. 3087. Watsonia. Don't think I've heard of Watsonia before, so that's interesting. I always love finding out new places. 3,700 households with 37% earning outright, 39% borrowing, 23% are renting, 6% in mortgage stress, 100% in rental stress, half in financial stress, 90% are houses, 2.42 people ratio, vacancy rates 5.4%, gross investment yield 3.1, net investment yield minus 0.2, average taxable 91,000 compared with 102,000 from the census, giving a multi-flag, multiple incomes go on the mortgage, $7,300 on average a month, with a third going on the mortgage, 2,444, and 26.5%, 1,944 going on typical rent. From a scenario perspective, the best case, a fall of 4% over 3 years, base case, a fall of 19% over 3 years, and the worst case, a fall of 38.8% over 3 years. And that will, I think, do us with regard to that. Just a couple of acknowledgements. Jason, thank you very much for the super chat. Really do appreciate it. Thank you very much for all your support. It really does make a huge difference to us. As Theo says, everyone is traumatized and they're going to intentionally make it worse. Probably exactly right. Cookie asked for Norfolk Island. I don't even know whether I've got Norfolk Island in my data set. Hang on, I'll just check, just out of curiosity. It's such a low count, 917 households. I'm not going to show it because it's not going to be representative of anything important. So there you go. Right. Well, I just want to come back then to the my final closing comments before I then close the show completely. I would like to make the point that as with this, I can never cover all of the postcodes in one show. But if you would like the snapshot for a postcode, you can send me an email. The contacts via the blog, links on the chat below. And if you ask for a postcode, I will send you the one-page snapshot. Of course, the other option is you can actually subscribe via Patreon, and that gives you access to the full set of data. This is the Patreon. You can subscribe at various levels, and thank you for all of those who do subscribe. It really does help to cover the cost of what we do here. But particularly if you want all of the postcodes, more than 2,000 postcodes, you can subscribe. It's $50 a month plus GST. And I'm sending this data out to the Patreon next few days. That gives you all of the data in the data set that you see here. And very importantly, allows you to compare and contrast different places. Oh, and incidentally, you might like this. I'll just show this because I think it's quite fun. I did add a random generator. So one of the things is quite interesting, just to say, give me a random postcode and tell me what's going on. So I can do this now, and I can literally flick through on a random basis, postcode after postcode after postcode. It's quite interesting. And when I first did it, I used a linear search, so weighting each postcode on an equal basis, but I kept getting lots of low count postcodes. So then I've weighted it by population. So the random generator tends to focus on the population. And so you still get a few low counts, like this one in South Tasmania, but you also get other places. It's quite interesting. And it's an interesting way of just touring around and seeing what's going on. So there you go. That's just a further modification that I made to the programming that I've done here. I like playing around with this. Anyway, now as I come to the end of the show, I want to make just a couple of closing points. People are in financial stress still. And sometimes people say, well, what should I do? Well, the first thing to do is to understand where you are, build a cash flow, see where your money is coming in, where's it going out. Then you can prioritize. And there are a couple of tools that can help. The first tool, of course, and I've mentioned this before, is the AFCA Statement of Financial Position. This is a tool that you can get from the AFCA site, and you can put in all of your details. It's a very useful tool because it helps to sort of crystallize where you are and what you perhaps need to talk about. And then you might need to get some help, and the debt helpline, National Debt Helpline, 1-800-007-007. They are very, very busy, but they're government-backed. And I do always make the point, it's really important if you go and get help, get it from the right people. Don't just Google it and find somebody who will start charging you to help, because that doesn't necessarily help at all. Once you've got your cash flow sorted out, and you maybe speak to your bank if you've got a mortgage. Remember, the bank quite often, though, will be helping themselves rather than you. They will suggest extending the life of the loan or going interest only. That just means you'll be paying more interest for a longer period of time. Now, if it's a short-term blip, maybe that's okay. But what I'm seeing structurally is a lot of people are getting into this situation where they're extending their mortgage for longer. They're continuing to make their payments, but they're not actually really getting out of doo-doo. So be careful when you take the bank's advice. That's why I believe it's quite important to get individual, separate advice, and that's why the idea of talking to the National Debt Helpline, 1-800-007-007, is a very useful thing. Plus, building a cash flow, prioritizing, and then looking about what you're spending your money on. Are you spending it on the right things? And sometimes what I find when I talk with people on their one-to-one conversations, they may be spending on things they'd like to spend money on, what things they should be spending money on. So that's very, very important point. And thank you very much. I really appreciate the support in the chat. The only reliable person with the facts. Well, I do want to share these facts. I share this not from sort of pleasure of sharing it, but because I want people to be more informed. If you are informed, you can grab hold of this and take a hold of it yourself. Because the fact of the matter is, it's not about the government getting you out of jail or the RBA cutting rates and making things easier. That may help some, but actually you've got to get your arms around the problem and then prioritizing and making better financial decisions. Just getting more loans, by the way, isn't a good decision. Going buy now, pay later isn't actually a good decision, or even horror of horrors, payday loans. Some people do that. So just getting more loans, just restructuring and refinancing doesn't necessarily help. So there are some really important conversations for people. And if you are thinking of getting into the market now, if you're a first-time buyer, please listen to what we've been saying here on this channel for some time. Don't listen to the spruikers that prices are going to go through the roof and now is the perfect time to buy. Sure, it might be for some people, but do your homework. Be sure to understand what would happen if rates didn't go down. Be sure you'd understand what happened if strata fees went up. I covered this the other day. And, if you're buying an apartment in particular, remember that the costs will be a lot higher for strata fees than you're probably budgeting for. So it is really, really important that you prioritize and make good decisions. And that's really what I'm here about. I want to help people make better decisions. And that's the critical thing. Okay, I think we're there. So I want to say thank you very much for spending some time with us this evening. And I hope this was a useful conversation. Stephanie said, can we look at the puppies before we go? Well, yes, you can. Here is Dog's View. There's Luna, some of Meteor. Oh, she's rolling away. Meteor, what you doing? Meteor, hello. Oh, she's come to see hello to me now, which doesn't necessarily help. Hello, what you doing? Do you want to come up here? No? All right. Oh dear. It's all good fun. Anyway, you can just, there you go. There's Meteor going back into her bed now, so we can zoom in. They've been wonderfully quiet today, which is great because sometimes they get a bit antsy, but and we're taking them out for another walk soon, but they're the doggies. And final to say that next week, oh, the dogs are about to bark. I'm getting a delivery. Next week, I'll be having another show, and I'll look forward to seeing you on the show then. And I'm going to say, Seb, thank you very much. Take care, and I'll look forward to seeing you next week. This is Martin North from Digital Finance Analytics, signing off. Take care.